Today, we will talk about how to assume a mortgage. Let's have a look at the details. Assuming a mortgage is a process by which you take over the payments on an existing loan, rather than secure your own financing to purchase the house. Some loans, like VA, USDA, and FHA loans, are inherently assumable. If you're thinking about taking over someone else's payment, make sure you know how to assume a mortgage before you sign any paperwork or hand over any funds. Assuming a mortgage is not limited to underwater mortgages. The first part is qualifying to assume the mortgage. Learn whether you are permitted to assume the loan. Certain types of government-backed loans are much easier to assume than conventional loans. In most cases, you must meet the qualifications of the government agency in order to assume the loan. Decide whether assumption of the mortgage is a good idea. There are certain situations where you may want to assume a mortgage. For example, when you assume a mortgage, you keep the interest rate that the original owner has on the loan. If interest rates have risen, then assumption may make financial sense. Find out how much it costs. You will have to pay the owner for the equity that he already has in the property. For example, if the owner has $140,000 remaining on a mortgage but the selling price is $200,000, then you need to come up with a down payment of $60,000 to cover the equity that has built up in the house. Check whether you can obtain funds. If you need to make a down payment, then you should figure out how to come up with the money. If you do not have the necessary amount in cash, then check if you can borrow the money from a bank or credit union. And the second step is assuming the mortgage. Request an application from the lender. In order to assume a mortgage, you must qualify with the current lender. 6. Without the lender's consent, you cannot assume the mortgage. Gather financial information. Along with your application, you will have to submit proof of your financial condition. Complete the application. You will have to fill out many forms: an application with the lender, a real estate agent agreement, paperwork with a title company, and other necessary forms. Answer follow-up questions and complete forms. After you submit an application, your credit scores will be pulled. You will also be sent forms mandated by the Real Estate Settlement Procedures Act. You must fill them out and mail them back. Sign an assumption agreement. Typically, this agreement is between the seller and the buyer. Depending on the loan, the bank or a government agency, such as a governmental housing authority, may have to sign the agreement as well. Attend the closing. Anytime a house sells, whether you assume the note or not, you should have a closing process to sign all of the documents. However, with an assumption, the closing costs will be significantly less than with a conventional mortgage. Thanks for watching this video. Please don't forget to like and subscribe to our channel if you like our videos.